Yeah, that crystal ball. Well, the markets are just continuing to grind. I mean, they're just really nothing too massively negative. So, but you never know when something will pop out. So, really, all we can do is look at just kind of follow the. I like to follow momentum, and then look at the kind of the price range of the markets and see if they start to get kind of what I call price exhaustion. But the cycle is still, trending higher, and we do get good seasonality coming into the second week of February, so into next week. So we'll see. But I'm glad everybody could join tonight. So we'll talk about, regardless of market direction, what we'll be talking about here tonight is two really great option strategies to really help you trade and navigate markets that get really a lot of uncertainty and more potential volatility. Because when that happens, we all want to keep our risk really defined. So hopefully these will be some things that can help you out down the road. Yeah, and I like your comment. Trending up in fits and starts. We got Powell and Yellen on the same page, trying to keep liquidity to the market. So that's definitely going to help things. Yeah, it will be trader. So another minute or two. We've got some people still rolling in. Hey there, Jeff. Got Dwayne. Yeah, I'm in Austin, Texas, and it's a beautiful day here. It's probably got a mid 60s, probably 70, but it's been super clear, beautiful day. No complaints on the weather here for right now. Oh wow, 14 inches of snow. Where are you located? K Connecticut. Ah, wow. Wow, that's a lot of snow, huh? And we got Tampa, Florida. We know that's nice and pretty. Oh, it's going to be a good Super Bowl. Looking forward to that game. I don't know who to root for because I love both those quarterbacks are my favorite. I just Brady's like love Brady, but I also like that Mahomes kid. Man, he is something else. He's right down the road from Austin. He's in a from a town called New Braunfels, which is really close to here. All right, yeah, should be a great game. All right, everybody ready to roll? So let us get started. Yeah, I'm here in Austin, Texas, Central Texas. Okay, well, again, just want to say thanks a lot for taking some time out to be here tonight, and we're going to talk about um, some ways that you can start getting tilting the odds in your favor, especially in uncertain markets. But these are strategies that you can use regardless. So we're going to talk about two of my favorite kind of low risk, high return or high reward option strategies, which are the butterfly and the long condor. Now, just a little background on myself. I've been trading, for over 30 years on the option side of things, and started my career back on the oil side back in the 80s. And so started out oil trader, trading cargoes of crude, and then products, out in Asia. So it was a fantastic start to the career, and then eventually went to a company called Trans World Oil, which was one of the largest oil trading companies in the world, and ran their trading group. Spent about 17 years with Trans World, and then ended up with their running the trading international trading desk out of Bermuda for 10 years. So that's a picture of me back in the 88, 87 area, and that's when I started trading options. It was like 1987. So, and just have never looked back because the option side of things are just really amazing. You've got just like the word says, options. It gives you so many different things that you can do. by incorporating options in your trading, regardless of if that's for, trying to help you make income, profits. But one thing that you don't want to overlook is the hedging aspect of using options, and that's where they were originally created. So we're going to talk about a lot of these things and the benefits of options, but with two really fantastic dynamic strategies that we're going to dive in and talk about tonight. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, what are the secrets to trading profits? So in my opinion, if you've been following me, there are three things that really create your successful trades. And when you break it down and you identify those three things, it comes down to price direction, timing, and then your risk management. So from the risk management side, that's where we want to incorporate options to help us with our risk management. So we can do so many different things by using options. Now, when we look at option trading, trading options has so many more advantages than just trading outright stocks, as probably everybody here knows, but it can be a bit more complicated as well. But once you understand the benefits and the advantages of options, and especially using option spreads, you're really never going to look back. So when used correctly, option spreads are going to do a lot of different things for you. The benefits are going to be to help you really define your trading risk, going to help you to lower your capital at risk. It's going to give you or provide you greater trading leverage for your trades. And the other thing a lot of times that's overlooked is, they provide you an unmatched hedging advantage. Now, I've been trading options for over 30 years, and I've found that the most valuable go-to option strategies that can really literally help any trader out there more than any other is to know, and especially know in extreme or uncertain times, is how to incorporate and use option butterflies and the long condor into your trading plan. And, I kind of refer to these two strategies as kind of my trading secret weapon. So hopefully as we go along in this presentation, you'll see why. Now, the huge advantage of these strategies is their unique option framework that's designed to take advantage of time decay, which is we call theta, and volatility. Now, these are the two main option pricing components. So we are able then to kind of stack the trading odds better into our favor, and then we can use these types of strategies in any type of market environment. But really, when you get into more uncertainty, where you really want to ratchet down and define that risk and keep your risk lower, these become two of the really great kind of go-to strategies if you just know then when to use them and how to use them. Now, because they're structured to require only a small amount of your hard-earned capital, your trading returns are going to be greater and you're going to really reduce your trading stress. So that's a really major win-win, and that's what's great about options and these strategies. We can really define our risk and we can really lower it, and then still have the potential for good high returns on that capital at risk. Now, when we look at the butterflies and long condors, they're very dynamic and they can be traded for a variety of different reasons with your different goals in mind. So you can, in other words, learn how to trade and use a butterfly or a long condor, and you're going to be covered for both your offense or your profits and also for defense, hedging and protecting your profits. So goals and protection. So really dynamic in that regard. Now, these two strategies can work no matter what the markets are doing. You can be, having an up move, a grinding up move like we are in now, or a severe down move or sideways markets. They can provide income from stocks that are going nowhere, eliminates the stress of you having to be perfect on that stock's direction or overall market, really helps to eliminate the time decay expense that you encounter just from decaying long options. And that's a real thing that I'm obsessed with is time decay. So this is a really great way to eliminate and reduce that and put it into your favor. And then they also help to take the unsettling guesswork out of your trading, can be structured for very low cost or low capital at risk. And as you're going to see here in this presentation, can offer you returns on that risk of 10 to 1 or higher. So, risking $1 to make 10 or maybe more. So that's an incredible thing also about these strategies. Now, the butterflies and long condors, they're very flexible as you're going to see ahead. And once you learn the fundamental trade setup, how they work, and then you can adapt these strategies to, your goals and your market insights. So you could structure them to be more kind of delta neutral if the markets are kind of range bound going nowhere. But the real beauty is that they can be used directionally, offering you either a bullish or bearish exposure to the market when you feel, pretty certain a specific stock is headed in one way or the other. Now, if you're wrong, though, this is where they really help. The butterfly and long condor is going to help you to manage that risk and at the same time retain the potential for large returns. So we can knock down our risk, lower the risk, but we can still have potential for big returns on that risk. And that's what really makes them a very kind of very useful strategy and very dynamic. Now, let's be real though, these option spreads are not going to give you that unlimited profit potential that you might get from just going long calls, but you're going to see that they cost you a lot less than buying outright options, and they're going to offer you an amazing risk reward trade setup. And when you look at the butterfly, there's no other option strategy other than if you just go long calls that will offer you this kind of return on your risk. All right, so this means that the butterflies and long condors that can really significantly increase the probability of your winning trades, but also are going to help you to reduce the risk of those potential trades. And that's really what it comes down to in your trading. Now, also when we look at the butterfly and the long condor, they can really be very, very helpful for hedging a position when you mess something up. So they can be used as a really fast, low-cost way to cover your you-know-what pronto when a position starts to go against you. And I've literally found no other type of strategy that can hedge as quickly and as well as using these two strategies to incorporate into your hedging of some kind of core position that you might have on. So by constructing either a butterfly or a condor around a strike that is under pressure from another core trade that you might have set up, such as if you do a lot of credit spreads, you probably know that, it hits your short strike, goes through it, you're going to lose. But, we can construct butterfly or condor around that and alleviate that problem, or we can do it to a debit spread. So it really becomes one of the best ways that I've found to immediately neutralize, and not only neutralize, but lower your risk of a specific trade that you might have started out with. So what you can do then is you can keep your original position open just by implementing either a butterfly or long condor hedge on your original position. So what this kind of strategy does, it takes advantage of the time decay component of option pricing. So while you wait, and many times that's all you really need, just that little bit more time for your original position to stabilize, and then it moves back in favor. So a lot of times you might get in a great trade, it looks perfect, it's moving up the day, and then overnight something happens, a headline comes out, and it's just stalled out. The momentum is gone for the short term. And now you're faced with, what do I do? Do I stop my trade out or stay with it? Maybe it goes lower and I lose more. But this is a way that you can incorporate into your trading plan to put either a butterfly or condor hedge around a core trade, and it'll help you kind of hold that trade while you're looking at it to stabilize. And then it's taking advantage of that time decay component, and you're actually a lot of times adjusting the price of your trade down from the time decay. So it really becomes a great way to incorporate this into your trading plan as a hedging kind of mechanism as well. So, once it stabilizes, a lot of times it takes a day or two or a week, and then boom, it starts to stabilize, go back in your direction, and you can take the hedge off or even leave it on. Now, when we look at the butterfly or the condor itself, they're fairly simplistic. They're just basically what we call vertical spreads. So here would be an example of like a call debit spread. So you're long a call and you're short a call. Or you could start out long a call and you want to hedge it, then you sell a call against it. But if we want to hedge it more, we can do that quickly by converting it to butterfly. So in this example, if we did this call debit spread, we've got $300 of risk right here. That's the debit cost, which is, defined risk. But you never want to lose the entire capital that you put up at risk on any trade, even if it's defined risk like a debit spread. So a couple of things we could do here. One thing we could do is we could convert this to a butterfly by selling a credit spread against it in the same option series is basically what you do. So here we could sell this credit spread, bring in $200 credit Okay, so we sell a call here, buy that call there, and now boom, we've reduced our original trade risk of $300 down to $100. Okay, so we've done that and we've converted it to what we call a balanced butterfly. Now, with this butterfly structure spread, we've got then a lot of different options that we can, put in place if we want. So we could leave it just alone and do nothing. And if it goes out within our profit zone, we could make even a bigger return on our profit or our capital versus the 300 that we originally had. We've reduced it down to 100. And if it goes out what we call the top of the tent here, we can make even a bigger return on our reduced capital at risk. So we got that, or we could, close out one side or the other side, let it go, or we could add to it. So there's so many things that we can do, but that's the beauty of it. We can immediately neutralize our risk and at the same time lower it, which is really super beneficial. All right, so that's what's great. When you're in uncertainty, we can do quick things like that. Now, when we look at a condor, the long condor, this is one I like to usually go to first for hedging. But what it does is we spread out the zone between our short strikes, so we're setting it out further, so we have a bigger profit zone. So a butterfly is great. We're going to reduce our risk by a large amount, but we're also going to have a kind of a tighter thread the needle type thing here to make the maximum profit. But by doing the condor, we can separate out and spread it out that profit zone. All right, so I love this strategy quite a bit. All right, so we'll look at a few examples here in a minute, though, but that's kind of the basic structure. Now, the core concept that really, helped to make the butterfly and long condor dynamic is to look at the importance of time decay. Okay, so when we look at options in general and the option factor for profit generation, especially when we're looking at the butterfly condor, the strategy really comes down to understanding how option pricing works and the concept of time decay or theta. Okay, so this is a big component that really helps these two strategies work. So the effect that it has on the price of your option. So let's kind of review that. Now, when we look at the theta, what theta does is kind of the option Greek that tells us how much an option price will go down over time. So it's the rate of the time decay of your stock's option. Now, time decay occurs because the extrinsic value or that time value of your option is going to go down each and every day, and eventually it's going to go to zero at expiration. So it's the decaying part of your trade asset when we do an option. It doesn't stay forever. It's eventually going to go to zero. All right, so that's important to understand. And then we can think, okay, how can we take advantage of that? And that's where we come in and we look at what we call the characteristics of an option. So option theta values have either a positive or a negative kind of characteristic. So if you're long an option, so let's say you go long a call, or if you go long a put, that's going to have what we call a negative theta value. So if the security that you're trading, that you bought that option on, a call or a put, goes sideways, that option is going to be losing money every day, and eventually it's going to go to zero at the end of your expiration of that option series. Now, the flip side of that, though, is if you short the option. So if you go short a call or if you short a put, that's going to have a positive theta value. And if your security goes sideways, you're actually gaining money each and every day from that theta decay. So here's an example. So let's say you have an option and you look at the option chain and it says it's got a minus 0.10, so theta on that option strike. So what that's telling you, remember, one option contract is equivalent to 100 shares. So if you were to lose 10 cents on that option, one contract, that means you're going to lose $10 per contract. Now, that's going to happen each and every day, even through the weekends or a holiday, even if the markets are closed. So, for example, if you were to buy an option contract going into a 3-day long weekend, and you paid $1.40, so that'd be $140 for one option contract, and then you come back after that 3-day weekend, you're going to see if it had that 10-cent theta decay, after the 3-day weekend, that's not going to be worth 140 any longer. It's going to be worth only 110. So if the price goes nowhere, you come back after that 3-day weekend and you bought that option, say on a Friday, you come back in Tuesday, and it's only worth 110. Well, that's what happened to you. That theta strikes again. but we can use it to our advantage if we just understand, what option strategies to use to incorporate to take advantage of theta. Now, when we look at time decay, you can see this graph here, how it affects when you get into shorter dated options. So when we start out further out in time, say 120 to 90 days out, the theta decay or time decay is very, very small. And so for an option buyer, that's a lot of times referred to as the gift of time. Now, as we get closer in, 30 days from your expiration, day zero, then the theta or time decay starts to really accelerate. And now that we have weekly options on most option or securities, it really accelerates, and we can take advantage of these weekly options for that theta decay. And then eventually it goes to zero, right? So that's the beauty of incorporating option strategies that have a selling component that combines selling and buying. So that's what the option butterfly and the condor do. It's got a component of like a debit spread where you're looking to go long, so you get the benefit of that if you're right. But on the other side of that, the other side of the spread is a short spread, which you're getting the advantage of selling time and volatility. So that's the beauty of it. You're really taking advantage of the option pricing. Now, when we look at the butterfly and the long condor, let's take a look at the structures. Now, first off, here's an example to show you how small and low you can get your risk. So here's that famous XYZ company. It's trading at $45, and we're looking for it to go, basically, we're looking for a directional move down to just 43. So with the butterfly, or condor, we can do these trade setups for small moves or very short duration or longer moves, but they're great for short duration because of the time decay component that we can take advantage of. So in this example, we're just looking for a move down to 43. So, what I teach our members at Power Cycle Trading is kind of a 7-step process. And one part of the process is you always have a target before you ever put the trade on. You always establish a price target. So in this example, usually I use Fibonacci, something like that. So here's 43 bucks. So it's trading at 45. We've got a target of 43. So typically what you want to do is you want to set the body of your butterfly at that target. All right. So here it's 43. So we're going to buy then. Here we're going to keep this really low risk. So we're going to buy the 44 put. That's going to cost $2.38 or $238, for one option contract. Now then, at the same time, we're going to sell the 43 put right below it, and we're going to bring in $1.67, and then we're going to sell it again and buy below the 43 put, the 42 put to protect us, cap our risk on the downside. Now, if you add everything up, this is where you get your cost basis of the amount of risk. So here you've got the 238 cost of that 44 put, the 106 cost of the 42, and then we receive the credit of selling that 43 put twice, $167 there times 100 to convert it to an option contract. And you can see on this example, the risk is $10. So this is what we call kind of a narrow wing butterfly because it's a dollar wide spread. Now, if you look at the potential profit, you just take a look at your strikes. 44 minus 43 is $1. 43 minus 42 is $1. So you've got your spread width is $1. All right. So 43 minus 42 less the cost, 10 cents equals 90 cents times 100. So this theoretically, if you hit the body of the butterfly at expiration at 43, which we call kind of a pin, you could make $90 on the risk of 10. That's a 900% return. Or the other way to look at it is you're going to risk $1 to make 9, right? There's no other option strategy that can do these kind of returns other than if you just go long a call and it just keeps going straight up. So this is really what makes it amazing. And then we can use this not only as a strategy for profit or income, but we can use it for hedging. Yeah, broken wing butterflies are all kinds of variations, and we'll talk about that. So then it comes down to the next step is, okay, well, what's the best butterfly or long condor to use? And so it really kind of comes down to what I call your trading goals. Now, one major goal of every trader, in my opinion, should be to select trades that are going to be based on what's going to provide you the most consistent positive returns. And with me, it's looking at low defined risk and not always that big home run. So if you can look at your trading as kind of just, you want to be in there hitting singles and doubles, and eventually you're going to hit, that triple or home run. But you want to look, in my opinion, look at trading as where you want to be very consistent, keep your equity curve or your equity drawdowns low. So by doing it with more defined risk type trades, and we can incorporate different option strategies to do that, we can keep our risk low, and then occasionally you're going to have that big one that runs, right? But you want to stay in the game, so you need to control that risk on each and every trade. So the first thing I always look at is the risk. Now, one of the best ways then to achieve, your goals of trading is then to understand what are the option strategies that are out there and available to me, understand how they work, and then look to go with the one that's best suited for the market environment you're trading or your specific trading goals. So, everybody here tonight, you might have, Gary. He can't look at the markets all day. He's more passive. But you might have Bill that's, he's in there every day just looking for all the different trades. Or you might have Bill has 100,000 trading account and Gary has, 5. So that's going to make a difference as well. But the one thing you'll find out if you study these trade strategies, the butterfly condor, it doesn't matter what account size you have. You can have a account of $1,000, or you can have $1 million trading account or hedge fund trading account of billions. So the strategies are workable for any size trading account, and once you understand how they work, they're easy to use and set up. Now, when we look at the butterfly, I kind of call it the butterfly family, there are some different variations, but what they all do is they take into consideration selling time and volatility when we do these strategies, because it has that sell side component. So we've got we have a long call or put butterfly. We've got what's called the broken wing or skip strike butterfly. We use calls or puts on that. We've got what I call the ninja butterfly, which is a ratio butterfly or unbalanced butterfly. We've got the iron butterfly, and then we've got hedging using the butterfly for kind of a defense strategy. And then we've got another category which is similar, but it's the long condor option spread. Now, when we look at just kind of the basics of a butterfly, and if you break it down, this would be like a balanced butterfly. All right, so if you look here, this is like on SPY. So if you bought the 203 strike here, and you're going to pay $3.10 in this example, so that would be $310. Now, at the same time, you're going to sell the 205 call strike above it, and you're going to bring in $1.70, and then you're going to sell that 205 again, bring in another $1.70. So here you've brought in $340 credit, and then you buy the 207 above that 205. So you can see the balance there between the strikes, and that costs 70. So the full value of this butterfly would be maximum risk is your debit paid of $40. Now the difference is the broken wing butterfly, all you're doing here is you're skipping out one strike, or skip strike, or breaking one wing sometimes it's called. So if you look here, instead of buying the 207, okay, which would be your balanced butterfly, you're going to skip a strike. So you can skip one or two or whatever you want. So by skipping that strike, you're going further out and it becomes cheaper. So that cost is 25. So you can see here, you've got the 310 there, you've got your 340, but instead of paying 70 for that balance, you skip the strike out and it's cheaper, and that's 25. So in this example, you actually have zero downside risk. You're actually getting a credit of $5. So that's typical of a balanced butterfly. Typically, it's going to be a low debit cost, or maybe you might be able to squeeze a credit. But then the other one is the ratio butterfly or unbalanced or ninja. So what this one does, it just basically is adding an additional credit spread. So here you're long the 203, short the 205, and then you're selling the 205, buying that 207. But instead of just doing it 1 by 2 by 1, you're selling one more credit spread here, and that makes it the ratio 1 by 3 by 2. And that extra credit spread then brings in the additional credit. And in this example, you have zero downside risk, and you've actually got a credit. So I like these more, I think of these more like just if you're doing a standard credit spread. And if you get it right and you get out within your profit zone, you can make even a bigger return. But if you're looking for the market not to go past your target price, and you're worried that it could go down, then you've got a credit of 60 in this example. But if it goes out in your zone here, this could end up making 2 or 3 times that, So it has a benefit for the right market condition. So let's take a look at the different variations and some examples here so you can get a better idea of the butterfly. So first we'll just start out with the simple balanced butterfly. Now, when you trade a butterfly spread, you can adjust the risk and the potential profit of that spread by what we call the wingspan. Okay, and we can use with the butterfly, yes, you can use puts or calls. Okay, but when we're looking for a directional move up, if you trade options, how do you trade a directional move up on options if you were to buy an option? So if you wanted to go long an option for an up move, what do? Right, you're going to buy calls. So if you wanted to do a directional trade to the upside using a butterfly, it's best to use calls. If you want to do a directional trade using a butterfly to the downside, it's best if you use puts. But we'll go through some examples and you'll see. So we can control the risk of the trade and the potential profit of that trade by what we call the wingspan. So for example, if you actually were a person that likes to collect butterflies, you're going to have a butterfly net, right? So if you had a really small, tiny little butterfly net, you're going to be swinging all over the place. You might hurt that butterfly. But if you've got that big, huge, wide butterfly net, it's going to be easier for it to catch it. So it's the same concept of the wingspan of the butterfly. We can control our risk by the spread width. So if we want to keep it really tight risk, we can make it narrow. If we want a bigger butterfly with a bigger zone, we can make it wider, which will make our profit, zone bigger, but also is going to increase our risk based on that. So we can do these kinds of risk adjustments based on the wingspan. So let's take a look. The first one will be a narrow wing butterfly, okay, with a $100 wide spread. And so SPY, the ETFs are great, for butterflies, SPY, QQQ, the Russell IWM. The index options are great for butterflies and condors, SPX, NDX, those types, or any of the various stocks or even futures. Now, in this example, we were just, again, looking for a small directional move up. And again, I used targets based on Fibonacci, unusual option activity, and kind of standard deviation price forecasting. Now, in this example, it's trading at 267. We were just looking for a move into Friday's expiration on the 16th, 2 days later. So it was trading right in here, and we're looking for a move directionally right here to that 273, 274 based on the Fibonacci and based on option activity being here at that strike. So how did we do this? Well, we could structure this using a lot of different ways. You could go long the stock, you could long calls, but we wanted to keep our risk super low. So here's the setup. So in this example, we're targeting 273. So that's going to be the body of the butterfly. If I can get my drawing tool here. So we're going to target this 273 area right here. That's going to be the body. So we go long, it's trading at 267. So we're going to go long the 272 call, sell the 273, and then at the same time sell the 273 and then buy the 274 above it. So if you look at this is a call debit spread and this is a bear call credit spread. We put the two together, we've just created a balanced butterfly, and this is a narrow wing butterfly. If you look at the spread width here, there's a dollar strike, okay? So 74, 73, 73, 72, that's a dollar wide or $100. Now the cost of the trade here was 10 cents, which would be $10 per option contract. And then the difference is what I call theoretical profit would be $90 per spread. If you nailed it perfectly on the 16th at 273, you'd make $90 per spread, which would be a 900% return on that risk of 10. Now with the butterfly, you'll never hit it exactly, but you'll get close, but you'll never get that exact amount. But 2 days later, in this example, it was up $70 per spread. And $70, if you made $70 on a risk of $10, that's a 700% return. So that's really the amazing thing about it. The returns are, on your risk can be enormous. So here's what it looks like going out. So this was on the 16th, expiration day, and it was going out pretty close to the target. It's 273.08 right here. Now this is the tent profit zone. And when you look at your analytics on, this is Thinkorswim, the teal color is what the price is at expiration. So This is how you tell your profit at expiration wherever it is. So it was trading exactly here at expiration 273.08. I'd look at that with my analytics, but it's trading right at that purple. That's what it's doing in time. So it's not a full profit of 90, but it's close. And all that little black area is what's left of the theta and the volatility that's still left in that option price. So this one went from 10 cents to 80 cents. So that's $10, and then went up to $80 per spread. And then that's your difference, is your profit of 70. And again, on that risk of 10, so that's a 700% return. So on this example, it was 4 contracts and it made $280, and your total risk on this trade would have been $40. So that's pretty amazing. You can control a lot of trading risk and direction for a very small amount of money. And I'll show you some other examples to kind of really illustrate that. Now here's another one. This is a short trade that we did last week, again using the butterfly. Now the other thing too is to think about when you're trying to, if you've tried to short this market, you pretty much can give up on it, but sometimes you want to take a short trade because whatever the reason might be, you think it's going to go down, right? And you want to hedge yourself, maybe use it as a downside hedge for other positions you have on. So we can do this type of hedging, or we can do these directional trades where we can really lower our risk on a short trade by using the butterfly. So here's an example. This is one we did last week. Now we were looking at, this was on the 27th, and we were looking, the market was, based on our trading model, was giving us a signal to go short, okay? But it's hard to go short. So we did this using a butterfly, and again, targeting, first thing, always have a price target. Where do you think it's going to go? So in this trade example, it was trading here at 376, right here, right there, okay? We used price momentum to give us direction. And so this was a break here, the support. And so we thought, okay, it breaks here, this 276. It's going to go, high probability to go to 370, which is that next support zone based on Fibonacci and moving average. This is a 50 simple moving average. So we did this using a butterfly because so many times you'll get a short, it'll go down, but then immediately, snaps back up. All right, so here's the trade. So we did this. This was on the 27th, and then this was set up. The signal, our short signal, came on the 27th, and we didn't take the trade until the 29th. This was like on Friday. This was a week ago on Friday. And so we took this trade. It was basically going into the next day was the 30th, was the end of the week. So we did this a one-day trade, and then we did this using the February 1 series. So this would be like for expiration Monday. And that's the other thing with SPY. You've got different expiration series. You could do a Monday expiration, a Wednesday, or a Friday. So we did this one with a Monday, thinking, okay, these short trades, they basically don't stay down very long. So we did this very short duration, targeting that 370. So here's the setup and how it works. So we did this with a put butterfly. All right, so we bought, target was 370. So we bought the 374 put, sold the 370, sold the 370, bought the 366. So if you look at the spread width here, that's $4 spread width, okay? And so $400. The cost of this trade, this is what makes it work, it was only 41 cents or $41. All right, so if you got it totally wrong, you set this short up on the 29th, and the next day you came in and it's trading $10 higher, and you weren't able to do anything, well, you just lost $41. Versus if you shorted it and had to borrow shares, or if you went naked short calls, you have unlimited potential risk. But this one, we've got a risk of only 41 bucks. And look at the potential profit. If you take the spread width of $4 or 400 minus the cost of 41, theoretically, if you nailed it at expiration and it was trading right there going out at 370, you'd make $359 per spread. That's an 876% return. But we weren't looking to make that. That would have been awesome. But we were looking to just make a risk trade, super low risk, that we could still participate for a move down. So in this case, the same day, actually, this moved down and this was up and took profit that day at $35 per spread. Doesn't sound like much, but if you look at on that risk of 41, that was an 85% return. All right, so one contract, if you did 10, it's 350. So that's what you're looking at. You're trying to control the risk in the market environment you're trading. So your options can give you so many advantages to shape a trade the way you need it for that environment. So here it was going out. This was the same day it was put on. Later in the afternoon, it crashed down. It was trading here at 370. And so this went from that original cost that day, $41 debit, and it was trading out up to 76. So there was that profit. You take your profit. Now, when you hit your targets, you always take your profit, even though you know it's not going to be the max. So we go into these not looking for the max profit. We go into it looking at the max risk. So it's kind of the other way around. So here we know we've got a maximum risk of 41. It hits our target, though, we start taking profit, which is still not bad when you look at the return on that risk. So it's $35. Now, the next day or over the weekend, we came in on Monday and it was doing what we were hoping it would do, and it was down on the open. So that gave us another opportunity to get out with even more profit. All right, so here it was coming in this past Monday on the 1st. And so it was trading down early in the morning to here 372. So not quite as good as Friday, but still pretty good profit right here because it's in the zone, the profit 10. All right, so this went on Monday. You got that additional theta. See the $32 there where my pointer? That's the additional profit that you brought in from that theta decay over the weekend. You got $30 additional profit to put in your pocket. So 35 plus 30 plus gave you a profit here of $53. So it went from 41 to 94 on that morning. So now it was up $53 on the risk of 41. So you just got an additional return on that, and that was a 129% return. So that's the key. So the way I look at it is I look at the risk first, and then I'm looking at my target, and if it's hit anywhere in that zone, I can then decide, to get out or leave it or stay with it or, close it out. But again, the first thing I usually want to always look at is my risk, and especially when you're in these goofy, uncertain markets where, one headline could sink a trade that you're in, so you want to define it. So that's another great advantage of the butterfly in that example. Now here is another great thing about the butterfly is that you can trade these big mammoth type stocks like an Amazon or a Tesla, or Nvidia or some of these really high price flyer stocks that have the big momentum. But if you're not able to trade options, and even if you bought a call on Amazon, it could cost you a ton of money. But by using a butterfly spread, we can trade a stock like Amazon that's currently, where did it go out today? Amazon went out at $33,312. So if you bought 100 shares of that, that's over $330,000. So we can buy options though and do it with a butterfly and control a big huge move to the upside on very little risk or very little capital that we have to put out. So here's an example. So here's an Amazon trade using a butterfly. It was trading at 31.50, and we were looking for this to break out based on our indicators, but we wanted to keep super low risk because if you get it wrong on Amazon, you can make it big, but you can lose it big just as fast. So we were looking for a target here to 3,200 to 3,220, this area here. And so what we did was we targeted again using a butterfly, and we did the target was right here of our butterfly. So we did a call debit spread side was 31.90, 32.20, then sold at 32.20, 32.50. So $30 wide, right? All right, so $30 times 100. So that's your spread width here is $3,000 on this butterfly. Now look at the risk here on this trade. So this was cost $3.88 per butterfly spread. So that's $388 if you did one spread. But that's the maximum risk. So if Amazon went straight down or straight up and you couldn't adjust it, typically we can do adjustments. We would lose $388. Now the other thing here, if you went and you bought 100 shares though of Amazon here at $3,150, well, you just put out of your account $315,000. So that's 100 shares because we're looking at one option contract equivalent 100 shares. So if you did that and you went from 3150 to 3200, hit your target, well, you made $50 per share. You made 2.33% return on that risk of 315,000. Huge risk in my opinion. But if you did this butterfly, you did basically you're doing 100 shares and your cost is $388. And if it goes out and hits your target at 3220 or 3200, let's take a look and see what that would do for you. So here, your spread width 3,000 less your cost. So theoretically, if you nailed it perfectly and it went out at expiration at 3220, this would make you $2,612 for one option spread, and that's over 600% return. Versus here, you made 2.33% with huge risk. Now let's take a look and see what this one actually did when this was all said and done. So here's the trade going out. And this was set up on the 25th, and it was going out on the 27th right here. So it was inside the profit zone. Now, it wasn't the max profit, but it was still pretty good. And the other thing, again, I look at the risk first. The risk here was 388, and it was trading right here. It was going out trading at 3210 right there, okay? And at that point in time, this was up $1,038 on that risk of 388. So this was up 267% return. If you did one option contract, would be equivalent like 100 shares. Versus here, you had that huge risk and you made 2.33%. Here, you had a risk of $388 and you made a 267% return. So there's just no comparison as far as risk reward on using these strategies if you want to trade in any kind of environment or on any stock as long as it has liquidity. Now, here's another example. This is on NVIDIA, another example of, a high flyer stock that you can control for very little if you do it with, say, something like a butterfly. So again, this was a breakout trade. We're looking for a move towards this 550 area right there. So this fib level 618 retracement. So we did this one targeting 550. And so we did the 535 call, sold the 550, and then the 565. So you can see there's a $15 wide spread, so 1,500. The cost on this trade was $2.20 down here debit, so that's 220 bucks. You look at the potential theoretical profit, take the spread width less cost, so 1,280 bucks or 581% return if you nailed it. Now here, if you did this, you would be out of your pocket $53,000, right? You make your target, you make $16 a share, 3%. Here, if you make your target, you have a 581% return. Now on this one, took profit here, okay, it was coming into that zone, it was starting to pull back, so we went ahead and took profit, but it went from this 220 to 427, so that was a profit of $207, okay, on that risk of 220. So here's our return of 94%. So 94% return, our risk is 220. Here, the return was, what was the return here? 3%, and the risk was over 53,000. So again, just to me, there's no comparison. And here's another really great example, some other benefits, okay? So another Amazon trade. But this one, I'm going to show you the benefit of time decay that you get and how it can really impact your profit in the same day, okay? So here's an Amazon butterfly trade. It had been coming down to the support bouncing, and we were looking for a target here to 1830. So we wanted to keep this, again, low risk. So this was on the 29th, and it was trading at 1,782. And we were looking for that target to this 1830. So again, if you bought 100 shares, you would be out of pocket over 178,000. And if it hit that target of 1830, you would have made $48 a share or 2.69% return. But that risk is huge. Now, in this example, one benefit, you're controlling a big high price stock by doing this butterfly, $10 wide, less the cost. Look at the cost here on this trade, it's 80 cents, $80. So you're controlling basically, theoretically, 100 shares of Amazon for $80 versus if you bought the actual 100 shares, you're out of pocket over 178,000. Now, if it did hit your target at expiration, you're going to be up $920 or over 1,150% return. But it hits our target, we're going to take profit. We're not looking for that, but we're looking at the risk. We can do a trade like this for 80 bucks. But here's the other really dynamic part of the butterfly. So this is what really also makes it amazing. So here it is coming in on the day of expiration, the 6th. This is in the morning, about 9:30 or 10 in the morning. All right, so the trade had gone from 80 cents, and so this was on the 6th, so expiration day, and it had gone to $230. So 80 to 230, so that's a profit of 150 per spread. So if you did one spread, you're up 150 bucks here in the morning of the 6th, September 6th. Now that would be a great return though, 187% return versus buying 100 shares here. But look at this trade about 3 or 4 hours later in the afternoon. This is going to be up now 4 times as much. And you're thinking, well, how can that be? See that black area there? This is in the morning. That is all that makes up the option spread, which is time and volatility. So that's all part of your potential profit that's still left in the trade. And that's in the morning. Now in the afternoon, all that, if it's hanging around this area, is stripped out and goes in your pocket. Now here it is in the afternoon, same day on the 6th, and it was trading at 1832, pretty close. And now it's trading right here, but look at the difference. You went from this in the morning up 150 bucks, 187% return. In the afternoon, now you're up $614 per spread, and that's up over 769% return. And that's your theta. See that little bit, black area? So you've stripped out, again, option pricing, time goes to zero, and volatility, and we're just taking that, put in our pocket, because these strategies take advantage of selling time and volatility. So see that theta here, $33. So it's a huge benefit. Now here's some examples of the long condor spread. This is one of my favorite. We can really control our risk, but we get a bigger profit zone. So this is an example of one we did on CRM about a week back. And so again, CRM had been coming off this big, huge sell-off. We wanted to keep our risk low. And so we did this using a call condor, okay? So this was on the 26th, it was trading at 226. And then today it was trading at 236, so it's up 10 bucks. So this is one we set up in the trading room. And so this was done with a condor to keep it super low risk. So here you can see this trade was done for a debit of 59 cents or $59. All right, so if you look at it, we're long the 227.5 call, sold the 230, and then we sold that 237.5, bought the 240. Okay, so we've got a call debit spread here, bear call credit spread here, and this profit zone here. Look at this big, huge. We've got a big wide zone. So earlier today, this was up $106 or $107 per spread on the risk of 59. Well, that's a 181% return on your risk of 59. All right, that's today. Now Friday, if it goes out inside this zone here, you'll take and hold the max profit of this trade, which would be $191. And on that risk of 59, that's a 324% return. So this still has that potential to hit that profit, this Friday. So I'll pull it up and show you here real quick what that looks like. 1 second. So, and that's just from the standpoint of using it as a profit trade and not a hedge. But these are great for legging. Okay, so I'll just pull up my analytics to show you real quick where that went out today, and it's still potential for $191 if it closed between the short strikes of the spread on Friday. So let me pull that up real quick. Here it is. Find it again. Okay, here it is. So here's what it looks like today going out now. So here it's $59, and that went out today up, basically $108. Okay, so if on Friday it's between these two spreads, the profit's $191, all it has to do Friday is expire anywhere in here, and on that risk of 59, so this would be up over 300%. All right, so I come over here, I go to my Data on Friday, you can see here if it's coming in the morning, we're trading right there. This will be up 157. And if it closes, see that teal color, hover over that, it closes there on Friday afternoon. So big zone there, it'll be 191 profit per spread. So that's on one spread. If you did 10, that's over, almost 2,000. All right, so that's just doing it as a spread. So we can leg in, leg out, and use these for hedges. So that's an example there. And so you can see here, your spread cost is 59. The potential max profit's 191. It went out today, up 107 or up 181%. Not too bad. But the big thing is that risk. Here's another example. This was one we did on Zoom back on the 14th. And Zoom had been just zooming all over the place. So we wanted, this was right here was the long, but it had this kind of resistance here. I was thinking it would blow right through there, but it didn't. Here was a big 50 simple moving average. So it just got up here and stalled. But here's the cool thing about this trade. Since we've got the sell side component, you're going to see that this made a profit even though the price was lower than when we set it up. All right, so here's the condor was set up, and this was doing like the 380, 382.5 call debit spread, then this sold the 422.5, 425. All right, so the cost of this trade was $85. That's the maximum risk. And it was going out here on the 22nd at 382.90. Look at this. When we set this trade up on the 14th, it was trading at 382.50. Okay. Now, when we took this off on the 22nd, it was trading at 382.90. So it was up just $40. But look at the profit on this trade. It's up $152 per spread on that risk of 85, so 178. And you say, well, how can that be? Because a big part of the spread was the short credit spread side of the trade, the 422.5, 425. So that was taken in. Most of the profit was coming from that theta decay being stripped out, on that 22nd. All right, so here you can see the 85 potential max profit 165, and this went out with about $152. Okay, so there's another great advantage. And then here's what we call, this is what Rick, who's here tonight, he coined this phrase, opportunistic hedge trading management. Okay, so what that means is you can basically, using these types of strategies, take a trade that maybe is directionally up, for a long trade, and the market rolls over on you, you can opportunistically adjust the trade to a short trade or something like that, or the other way around. So you can just really take advantage of the different shapes of an option by what I call mixing and matching the vertical spreads. So here's the trade entry. This was doing a SPY put debit spread. We were targeting again this fib level down here at 270. And so we did this with the put debit spread. So went long the 273 put, short the 270. Very nice defined risk trade, $65. Okay. Spread with $3, 300 minus 65. So potentially if this expired at expiration below the 270 or below, we'd make $235 per spread on that risk of 65, so 361% return. So nice structure on the trade, but it's hard to short the market. So what we've learned is if one thing we could do, so we start off with, say, a debit spread, is when it hits your target, you take profit on part of it and see if you can adjust the balance for what we call a free trade, or maybe even bring in a credit. So here, when it dropped down to 270, it broke through that area and it started going down hard. So the first thing we did was take partial profit here of $98, okay, which is a pretty decent return of 150. But instead of taking it all or leaving it alone, when it rolled down and hit down to that 270 area, we were able to sell the out of the money bull put credit spread, sold the 268, bought the 265. So it's trading down here at 271.37. So did that out of the money bull put credit spread and brought in $65 of credit. Okay. So now we've got a put condor. So we had on the buy side, we had spent $65 on the debit cost here of the put debit spread right here. When it flushed down to that 270.71, we sold the bull put credit spread out of the money, brought in 65. So now we have zero risk on the trade, and we can just kick back. And if we go out here in between the perfect area here, the short strikes here, we would make 300 on zero risk. But it goes out right here, and it's up about, it's going out about 271.33, and now it's up 164 per spread on zero risk. So what it does is it lets you sit back and you're not stressed out worrying about the trade, and you can try to take advantage and maximize your trade by doing these kind of adjustments. If you just kind of you think forward like you're playing a game of cards or chess or something. So that's the beauty of it. So here we converted a trade that had a risk of original trade was 65. We did the adjustment, and now we've got this trade with zero risk, and it ends up making $164 on the second part of the trade. So trade one, you make 98, 150% return, not bad. But if you did the adjustment, if you're just thinking ahead, you have zero risk and you made 164 on zero risk. So beautiful setup there. You can see here 0 and 300. So just a lot of things you can do once you understand the concept of these spreads, how they work. So what I'd like to show you now, if you'd like to learn, really how to really master these what I call high reward, low risk kind of strategies. And again, they work in any environment. Two things you can do. Hopefully you got enough out of tonight that you can start implementing some of these things tomorrow. But if you'd like to really learn it and learn it at a great value, and it's yours forever, and just think this is an investment in yourself, I'm going to be doing not this weekend, but the next weekend, the Saturday, the 13th of February, I'm going to be doing a butterfly and long condor option profits and hedging masters course. So this will be a live and recorded course, and it's going to be a tremendous course because of just the dynamics of these two strategies. There's a lot more to them than I could just go into tonight, but if you'd like to join us, the other thing is you're going to get a great package here, great value, and again, all this is yours forever. And 197, you're going to make, literally make that back really fast. So here's the link if you'd like to join us, and I'll go through all the bonuses here. So use that. If you should be able just to click on it, so it's powercycletrading.com/1 BF like butterfly. Make sure that link works. Okay, so here you go. Okay, yep, looks good. So let me show you all the bonuses that you'll get, not only the live course, but you're going to get a lot of goodies with it. So you'll get this right here. You'll see that drop down, all the things you're going to get. And then let's go through the bonuses, talk about the course, and any questions, let me know. So let's go through. So here are all the bonuses that you're going to get for this course if you'd like to join us. So you're going to get the 5+ hour. This will end up probably be 6 hours at least, because what I do with the course is I like to, try to answer questions as we go. So you understand if there's something that you're confused on, I can usually address it right there, and we can move on to the course and you understand, you can follow. Now here is, so you're going to get this. So 5+ hour course live. Then we take the course once we're done. We break this course down into modules of 30 minutes or less, like a chapter. So each part of the course is a module or a chapter. Okay, so these are all broken down. Now you'll get all the recordings here. This is yours forever, and you'll get this on the cloud. You'll have a member. You'll have your login, and even if you don't stay on as a member of PowerCycle Trading, you'll always be able to access your course material. Okay, now part of the bonus, you'll get that live, but then you'll also get it recorded. Now to get you started, you're going to get my options Masters Butterfly course that I did last May, June. Okay, so we're going to give you that right away. So this ended up a 6 hour plus course. And if you go to my website, this course is $397. So you're going to get this one on demand right away to start if you like. And then you're going to get bonus 2, my Fibonacci price mapping course. This is a course I did just about in December on using Fibonacci to do what we call price target mapping. So setting price targets for either profit, take, or defense levels. So you're going to get that. That's for sale. Actually, I think it's $397 actually on the website. And then you're going to get my new course, Option Beginner. So even if you're a beginning option trader here and you're just starting out, this is a great course for you to start out with, because again, it's only $197, but this is yours forever. And you're going to also get to go start with the Option Beginners course to help you kind of get on the same page. And then you'll dive into this course in the way that I lay the courses out, I started out in a kind of a process, so you'll be able to follow. And then you'll have a live follow-up Q&A, which will also be then recorded. We'll send you a link. That'll probably be 1 week later. You'll also get my option trading tutorial. This is kind of like another option course with videos and the tutorial on basically the option Greeks and probabilities, things like that that are important for your option trading. You'll get my option strategy manifesto, 15 different option strategies. You'll get my power tool guide. This is so you can print this out, put on your desktop to have the Greeks, what they are. And then you'll get a trial membership. You get 30-day free membership to my trading club. And if you'd like to stay on, then it becomes a $97 a month, or you can do an annual membership for $488. Now, with this trial membership, you can start it when you want. If you want to start it after the course or a week, month later, that's fine. Just let us know, and we can, by email, we'll start it whenever you want. But that's everything you'll get here in this package. So it's a fantastic way for you to start, looking and mastering these two option strategies. And then, again, all this is yours forever, and you'll have access to it. So you'll definitely get this back, and then 10 or 10x. Okay, so again, use this link here. Now, if you like to go to one step further and have even more help in your trading, I've got one more package that you might want to look at or consider, and this is my alert service package. Okay, so course package 2, if you want, you can take, this comes with everything you're seeing here. Okay, you'll get all the bonuses, the live course, everything here. But if you'd like more help in your trading, I've got my alert service package. So this also will give you my 4 trading alert services. So I've got the breakout reversal trades, butterflies and long condor trades, calendar diagonals, and earnings. Okay, so these are 4 different options services that I text out, these selected trades. Okay, so today I did an earnings trade on Merck, text that out. Today we did a condor on Boeing, and then last week, we did a calendar diagonal on CRM. So I'll show you some of these. But so you get all 4 of these alert services, and these not for 12 months, but for 13 months. And this also gives you my trading club for 13 months. So if you'd like to do that, I'll give you the link for this, and it's $1,000. And there's a 2-pay, but this is going to really help you because I'm there helping you, kind of mentoring you with your trades. And if another big hard part of trading is getting good trades, selecting the trade. It's a big part of your trades, and that's what I do. I've been doing it a long time, so it's probably a lot easier for me to select trades than probably for you selecting trades. And maybe you don't have the time to be looking, but that's what I do. So here, use this, and it's going to be $1,000, or there's a 2-pay. But again, you're going to get everything that you saw here in package 1 for $197, all the bonuses and everything. But you're going to get additionally all 4 of my alert services, and then the trading club for 13 months as well. Typically 10 to 20 stocks or ETFs a month. And today we did Boeing, and I'll show you that real quick so you can see what it looks like. And we did Merck. I text those out to the members, and let me pull that up, and I'll show you what you'll see. So you'll get this as a text, or you can have it as an email, or you can have it as both. So I've got a text service that puts these out. It takes about 2 to 3 minutes typically for you to receive the text wherever you want it, whatever mobile device. But here's a couple that we did. Here's one. These are alerts. Yes. So yesterday we did a text trade. We did Oracle. This was a calendar diagonal. Okay. And then today, here's the one we did this morning. This was a breakout trade that we did this morning. Sent this out about this was 9:50 or so. So this is the trade that we did. So this was Boeing. It was trading at 204.50. And so this is the text you would receive. It says buy to open a vertical Boeing, the 205, 207F called debit spread. It was around $1.10 or less. And then I'll tell you what I was trying to do. We'll look to convert to a long call condor on a move higher by selling a bear call credit spread with the short strike of a 20 or 25 delta. Now you'll learn all of this kind of stuff in the course too. So if you're thinking, wow, what the heck does this mean? This is what I'll teach you in the course. And then, or I said too, you could just set this up as a long condor. So here was the trade on this today, and let me show you what this looked like. And so the basis of the trade was a breakout trade, which um, was the setup. Okay, let me get that for you. I'll get my chart. I'll show you the trade, and then I'll show you the option trade. Okay, so here was the Boeing. We've been watching it, and then this was the breakout trade. And so here's the breakout, and this is using my trading model. And so trend line break, momentum, a lot of things together with the trade, but here's the reason for the trade. So you can see this trade. So it was trading right here at 204.50, sent this out on that break, and we did this, started out with a call debit spread and then converted it to a call condor. Okay, so here was the trade setup, ended up with a condor here with a cost of 65 bucks. All right, so went up we got a good edge on it because it's kept moving higher, and sold and hedged it into a condor. So the trade today then ended up being long the 205, 207 and a half, and then sold the 217 and a half, 220. And so net cost of 65 bucks, went out at 105. So the maximum risk is $65. Potential max profit if it closes here next week is 185. And so got a nice edge here. So that was one sent out today. Here's another. Then another one that was sent out today was an earnings trade. So this was it's up to you if you want to take the trade or not. But here was the earnings trade. Let me show you that. So here was the trade. This was on Merck. This was an earnings double calendar. So that was sent out today as well to the members of the alert service. So, just in summary, you'll get all four of my services. So it could be that you get an earnings trade or a calendar or a butterfly. So today you got both. You got a calendar and earnings, and then on Monday you got a calendar diagonal. Now with this service, you'll get a trade guide for each. You can do your own thing, but I'll always give you an option trade you can use and how to, what option series. I'll do a trade setup video. These are all listed and archived for you, and then you have access to the trading club for 13 months. So you'll get our Q&A every Tuesday, live and recorded. You'll get my market video newsletter every day after the close for 13 months. You'll get access to my virtual trading room every day during the week for 13 months, and discounts of 60% on all courses and software on the website. Here's a summary of our trades. The first service I started out was back in May of 2018. These are breakout kind of momentum-based trades. These are typically just going to be called debit spreads or put debit spreads. So 136 trades closed, 103 winners, 4 break even, 29 losers. The big thing here is the selection of the trades, high percentage winners, 79% there. The butterfly long condor alerts started this back in May of 2019. We've had 54 trades closed, 38 wins, 3 break even, 13 losers, high winning percentage, 76. But these are very, very low risk defined trades, 30, 40, 50, 60 bucks, 100's probably the most, but these are butterflies and condors. So you get really good 2x, 3x, 4x type returns. Been doing a lot of calendar diagonals. These have been fantastic. So we've had started this back last year in June, and we've had 60 close, 48 wins, 1 break even, 11 losers, 82% winners. And then the earnings trades, these are very selective earnings trades, and these are really high winners. 48 trades, 40 wins, 1 break even, 7 losses, 85%. So the one I sent out today, we'll see how it goes, is on Merck doing a double calendar. So just if you're interested in that, use this link here. And again, you can start your club membership, the trading club. You don't have to start it right away. If you want to start it a week or a month from now, just send us an email. Now in the course, here's kind of an outline of the course. We'll start this again, will be this, not this Saturday, but the next. So we'll start out with the option Greeks that are vital to trading a butterfly condor, how theta decay works to impact the spreads, the importance of volatility and how to use that, what we call volatility crush, and then how option pricing works. So you can take it, so in any of my courses, I try to teach you these core basics of options so you understand the effects, the importance of option pricing, which is going to be time and volatility. So you'll learn how that affects price. So you'll understand that for any of your option trading. and then using Fibonacci price mapping. And you'll have my course that I just did on this, which uses Fibonacci and standard deviation to forecast our directional prices that we're looking for. Part two, we go into the actual core basics, what makes a butterfly condor work. And I'm amazed that so many traders don't ever use what we call this long condor. It's one of the best things out there, so don't tell anybody. It's my best kept secret, I guess, except for these people that are here today. If you join us, you'll learn the secret. And then what the foundation is, how we use vertical spreads. And then we get into the variations of the butterfly, okay? So we're going to go through in this course, I'll take you through how, why, and when to use every type of butterfly. So, when would you use a long call or put butterfly? And I do this with different trade examples, so you can actually visually see the trade setup and see what it looks like, how it worked. And then I'll take you through the variation of using the wide wing butterfly, a broken wing butterfly, the ratio butterfly. Here's another one, the broken wing ratio butterfly, iron butterfly, vacation, butterfly, long condor. So we'll go through each one of these in the course. So you'll see how, when you should use it, and then you'll have it in your toolbox of whatever type of condition of the market is. Maybe I should use a broken wing butterfly here. Oh, maybe I should use the iron butterfly. All right, then what's the best option timeframes to use for the butterflies and condors? Should I go out 1 or 2 days or 2 weeks or 2 months? How do you get those 10 to 1 or greater returns? How do you structure those? How to profit and take advantage of what we call volatility collapse and that theta decay, how that works and how to put it in your favor. And then here's another really great part. This is a kind of a chapter of the course, is using the butterflies for what we call monthly option expiration. Okay, so that's what we kind of refer to as option pinning. It's a lot of fun, but it's 12 times a year. So this is an additional kind of stream of income you can add to your trading. And we do this, we'll take you through using my price target analysis, which you'll also have my Fib course on this, of how to establish and set targets using option activity and Fibonacci for these types of pinning trades, and then how to structure the butterfly for this kind of pinning trade. So you learn that in the course. So that's kind of a separate chapter of the course. And then we'll get into the long condor, big chapter of the course there, how to use the condor, long condor, to structure these low capital risk trades with a wider profit zone, and then how, why, and when to use the trade. And then we're going to get into hedging. So this is going to be a big part of the course. And we'll go through, I'll give you a checklist of what you look at for each and every trade first. And then we're going to get into what I call progression of hedging. I'll take you in the course, and it's going to be a progression. So if you had say your long stock and you wanted to hedge that, or your long calls or puts. So we'll go through the progression of hedging. I need to put that in. And then how to hedge any kind of core position using the butterfly or long condor hedge strategy. So typically I like to start with the long condor hedge first, and in the course I'll teach you why and how that works. And then we've got the butterfly strategy we can drop down into or add to it. And then part of the course will be how you can use the butterfly or long condor to defend a vertical debit or credit spread. So if you do a lot of credit spreads and you've been getting eaten up, this course will show you some defensive strategies to defend a credit spread. All right, there are about 5 different defenses that you'll learn here. And then the execution management of the butterfly condor, how that works. And then you'll get assignment risk, expiration, auto exercise, kind of a resource here, what those are. We'll go through in the course and tell you, what that is, what to look for, how it works. And then you'll get a library of trades here, 58 different, different trade pages. And to me, it's real helpful to go back and look at old trades, kind of see how they work. And so you'll get a trading library there to help you. All right, so that's kind of the basis there. Here's a little feedback here. So this one I just got in here last week, and this is Alicia. She's a newer member, but she said, I've never seen anyone explain options like this. It's excellent. This is exactly what I've been looking for. Very informative. No one has this anything like this. Wish I'd found you sooner, but I'm glad I found you now. So thanks, Alicia. And this was from Pam. She's one of my members. She's been with me for a while now, but she said, excellent class, Larry, as usual, under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money on credit spreads. That's so true. And then Jim, who's a longtime member now, he says, thanks again for showing so many ways of, here's the big thing, getting out of trouble. Really could have come in handy in the past. And my trading P&L would have been totally different. So that's the thing with the, that I'll spend a lot of time on in this course is how you can get out of trouble using these two strategies. They're the best for getting out of trouble. All right, so here are your special options bonuses. So first off, you're going to get the on-demand options masters course that I did back in May. So you'll get that right away. 6-hour plus course, 30-minute modules broken down, PowerPoint, 368 pages there. Very extensive course. You'll get that right away. Then you'll get my new price target mapping course using Fibonacci, moving averages, price action support, standard deviation, unusual option activity. This is all part of the course. So 3-hour plus course there. You'll get that as a bonus. And the options beginners course. So this is a really nice, comprehensive, easy to understand, option course to start yourself out with. It goes through what are the benefits of your options using that versus stocks, what are puts, calls, option expiration, beginner option strategies like a covered call or protective puts. And then we'll do a follow-up Q&A. So this will be live and then recorded. Then you're going to get my option trading tutorial. So another basic option course, 60-page option guide with videos on the Greeks, option pricing, standard deviation, delta, and probability. So you're going to have a full trading library for your options. And then my option strategy guide, 15 option strategies here, how they're constructed, when to use, like a back ratio spread or a calendar or a diagonal or a straddle or strangle. You'll get that. And my power tool guide here is the Greeks that you can put out on your print it out, put it on your desktop. And then last but not least, you'll get a free trial membership, 30-day trial. And again, you can start it when you want. And this will then give you access to my trading club, Q&As every Tuesday, after videos, newsletter every day after the close. And here's a really good feedback. So Larry, just wanted to let you know that I have found your service. I'm learning so much. Thanks, Richard. And here's Jay says, Larry, I just want to let you know my option knowledge has leaped exponentially since joining your trading room. It says reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. And then KG said ditto to that. Now with the trading club, and if you do the alert service, you'll get this for 13 months. You'll get access to the virtual trading room, which is open each day during the week, 9:30 to 10:30. I'm in there for the first hour of the morning. And then I come back in the afternoon for the close on Monday, Wednesday, Thursday. But every day during the week, I'm in for the open for the first hour, and it's just me. So if you have any trading questions, if we're looking at different trades, we go through all that during the day. So you've got a lot of access to me for questions. And then I do a video newsletter after the markets close. This comes out after the close every night. So it kind of goes through an overview of the market, what trades we're looking at, any that are coming up. These are all archived, and then we do every Tuesday a live Q&A that is also recorded and archived. Educational vault material, 6% discounts on all courses and software. Trade alert service, again, you're going to get if you want, and let me give you the link. You'll get all 4 of these alert services, and you'll get these not for 1 month, but for 13 months, and that comes also with the trading club for 13 months as well. So here's that link, and it'll save you a lot of time and expense because I'm doing a lot of the research, finding all the great trades for you. And so then all you have to do is execute the trade or ask questions. So you'll get my breakout alerts, my butterflies or condors, calendar diagonals, earnings trades. You'll get a trading guide for each. Let me go through here what you'll see here. I'll back up here. Okay, yeah, well, join us. Make sure to join us, Royce. Yeah, here, this is so true. Okay, here you go. Stop doing credit spreads, okay? This is so true. I've seen everybody loses on credit spreads. See what the credit spreads are called, probability trades, and there's a reason for they're called that. Oh, hold on a second. Anyway, this is good because this is so true. Hold on. So here's a good example. This is trader. Okay, doing credit spreads, you know, for 2 years, started with 30K, now he's at 28K. So what does that tell you? Stop doing credit spreads. So what does it tell you? Okay, here's the deal. When you do these types of strategies, what we're doing is we're taking the best of using credit spreads, but adding credit spreads with debit spreads. Okay, so we're mixing, kind of mix match, and we take the best from the two different verticals and we put them together and we create butterflies or condors. So we're still going to do credit spreads, but instead of you losing on a credit spread, you're doing the credit spread as part of another trade strategy or structure. And it's a lot better than just doing credit spreads. So in the course, you'll find out you're getting the probability trade side of the credit spread, but you're marrying the credit spread with a longer type of trade setup for a bigger profit. Okay, so bigger return on your risk. So with a credit spread, you're always going to have what we call a negative risk ratio. So you're going to always be risking more than what you can make on a credit spread. That's how it works. And that's why it's called a probability trade based on probabilities, which are theoretical. But when we do a credit spread, when we marry it with, say, a debit spread or something, we're getting a better combination and a better return on our risk. And we're getting the benefit of the sell side, selling volatility and selling time, and the benefit of the debit spread side for the big return. So here's a really good example, that the one I just showed you on Boeing. So hopefully this will show you what I'm trying to explain. So with this, if we look at this condor, what we've done here, now you could have sold this credit spread here. So you could have sold this 12 February 217.5, 220 bear call credit spread and brought in 40 bucks. Okay. So if you look at that, look, this is what we call negative risk ratio. Your potential profits, the credit received of $40, right? That's all you can make. And you make that if next Friday, the 12th of February, not this Friday, but next, it closes below 217.5. You make 40 bucks, but your risk is 210. You're like, why in the hell would I do that? You know? So you've got it. That's what we call a negative risk ratio. You're risking $210 to make 40. It makes no sense to most people. But what this is called is a probability trade, because when we look at the probabilities, you'll learn this in the course, but I'll show you real quick these are theoretical. So, theoretical doesn't mean it's going to work. But that's why I don't really ever use credit spreads by themselves unless I use it with a combination of something else. So if we look here at that 217.5 call right here that was sold short, see that? That says 24 delta. So theoretically, without going into much detail, you'll learn this in the course, there's only a 24% chance that the price theoretically will get to $217.50 over the next 9 days. So that the probability of it closing below 217, if we put this on probability out of the money right here, so if you sold that 217.5 short strike right there, the probability of this trade closing next week below 217.5 is 77.82%. Let's call it 80. So you're starting this trade out theoretically with an 80% chance this will be a winning trade. And for that reason, all you're going to get is 40 bucks. But if you've done credit spreads, you'll know that so many times you'll go through your short strike and you're going to end up losing more than the 40. So let's say you had 9 trades and you made 40 bucks on 9 trades. All right, so what's that? It's almost $400, okay? So you had 9 trades and you made 40 bucks, okay? And so these were all probability trades. So you start out with 80% probability, but then you have one trade and all of a sudden it blows it up, and now you lost $210. So you just went from making $360 and now you lost 210. So now you're almost down to back to break even. So just like, what Trader said, he started out with 30,000. Now he's at 28,000. But when you marry this then with the debit spread on the other side of it, here's where we started with the call debit spread, 205, 207, $5. That went out up 32. But look at this. So my risk here is 105. But if it closes above my spread here on next Friday, the 12th, I make $145. But my risk is only 105. So that's a positive risk ratio. So I can make 145. Okay. My risk is 105. So this is 138. So I'm risking $1 to make $1.38. But here I'm risking $210 to make 40. But you put the two together, and then what this does, see this theta here? I get this additional theta, but there's just a lot to it. Okay, so that's the way to do it, in my opinion. All right, so if you want to learn that, join us. Now, with the alert service, this is from Jay, who started out like anybody here tonight with buying a course, 30-day trial, but then Jay now has been a member of the trade club for a couple of years, I think. Said, I'm loving my subscription to the trade club and the alert services. I paid for it in my first week. I guess now I'm a scholarship student. And Jay, he's retired, but he says it's a great way to start his day, finish it, not be glued to the screen all day. Just, follow Larry, put the trades on, and then he comes back in for the end of the day if he wants, and goes from there. So, but basically he's retired and trading is now his hobby, but he wants additional help, and this is really giving it to him. So this is exactly what I've been looking for, and I'm learning like a sponge every day. Kind of regards, Jay. Now this one just came in. This was from Waleed, and he said, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts, and he goes on. He say, Waleed lives in Kuwait. He says some are good, others are not that great. But he said one thing that I would like people here on this webinar. This is one I did last Saturday. He said one thing I'd like everybody to know is that when I get a trade alert from Larry, I do it blindly, as time has shown me that I need to change it. This man is dead accurate on his recommendations. Thank you for your great trade service. Okay, so that was really appreciated. But that's what I try to strive for. Now with each trade, you can do your own thing, but I'll always give you an option trade if you want to use it. It'll give you the entry level, profit targets, unusual option activity, what option series to use, stop loss levels, guidelines. These are all listed and archived. And then I do a setup video of it. Then for 13 months, you get access to the trading club. So the virtual trading room, Q&As, all that good stuff. And here's just some examples. This was a breakout trade on Amazon. Okay, so here was Amazon. So we did this back in November. This was a breakout trade, and this was using a debit spread. Okay, so I'll flip through it real quick. So we use a call debit spread. Our total risk was $193, and it was trading right here. And we converted this though to a call condor. So we sold a credit spread against it, reduced our risk down in this example to $73, and then it went out trading right here. We were up $130 on now our risk is 73, so 178% return on a Amazon that was trading, if you did 100 shares over $320, $320,000. Here's the next Netflix trade set up. This was also a breakout trade using a debit spread. So here's the text out there. KG has been a member of the service now for about 3 years. When he bought it, he said he paid $1,200, and he said he made it on his first trade. So great price traders, well worth the investment. So this was a breakout trade on Netflix using a call debit spread. So defined risk $105, max profit there ended up $145. Here's some butterfly alert trade setups. Here's that SPY trade alert I showed you here earlier. This was a short trade using a put butterfly. I showed you that one earlier, so we'll flip through that. Here was a Zoom. I showed you that earlier. That was a long call condor. So this was an alert trade setup. I showed you that earlier. NVIDIA, that was a butterfly trade I showed you earlier. That was an alert trade. And this was one that we converted into a butterfly. Here was another short trade set up on QQQ, a put butterfly. Look at this. So this was a risk of $30, right? So that's how low the risk is. And this went out with a profit of, we hit our target, we got out. So this was up $65 on that risk of 30, so over 200% return there. This was a butterfly. This trade started out was a calendar that we then adjusted to a butterfly, and this was on GLD gold. So here was the trade. The first trade, part of this trade was a calendar, hit our target, we took profit, and then converted the balance to a butterfly targeting 175. So here's the butterfly here. So look at the risk, 89 bucks. So per spread and up to 210, so 236%. Now these are really fantastic trades too. We've been doing a lot of these. These are calendar diagonals. This is one we just set up recently on CRM. This was started out as what we call a call calendar, and then we did a couple adjustments. Long story short, it went out today up $416 per spread after the adjustments, and so these are trades that are sent out. So here's that text alert there, new CRM trade. Here's the adjustments, so you get all those. So that's a calendar that was converted to calendar diagonal. Here's another calendar on Apple. All right, so there's Apple, and then converted this to calendar diagonal. And so this was then converted to a butterfly for credit of 40 bucks. There you go. So just all kinds of creative stuff. So, I'm an option nerd. My passion's options. So I do all these kind of different structures, and I pass it on to you if you want to learn them, and I text it out to you. AMD, here's another calendar. So these are all alert trades, and these are all trades that we also talk about in the trade room if you want to come in. And so this was also converted to a butterfly with zero risk. So always looking to enhance. Here's a Microsoft calendar adjusted to a call debit spread for a big profit, 536 bucks on a risk of $1.79. Look at that. We adjusted this down to a risk of 179. So 300%. Now here are the earnings trades. Here's one that we did this last week. This was a Microsoft, a double calendar. This was really a fantastic trade. So here's what it looks like. This went out. The risk on this trade was $183, and this trade ended up with a profit of 163 per spread, or 189% return over a few days period. But these are very, very low risk trades. Okay, so there was the calendar. There was another one we did in October on Microsoft double calendar, etc. So that's it. So hopefully, I hope I got your questions. I know everybody's probably tired, but if you'd like to join us, please take advantage. I think you'll really be happy with the results and be glad that you came out tonight and join me for this course coming up and any future courses. So please use that link. And if you want the alert service, 197 here, but if you want the alert service, use this link. And there's a to-pay if you'd like it as well. So that's pretty much everything. Hopefully, if I missed a question or something you'd like to ask, please do, and we'll take it from there. Trading platform, yeah, TD Ameritrade is fantastic. Interactive Brokers is fine. Okay, TradeStation is good. Tasty Trade is good. So there are a lot of good platforms. I use Thinkorswim, but there are a lot of really good platforms out there. Yeah, a lot of people trade credit spreads. That's true, but I don't know how much of them, how many of them actually really make money, to be honest with you. But like I said, these strategies combine credit spreads. So I could say I trade credit spreads because I do, but I trade credit spreads combined with another spread. All right, so however you want to describe it. All right. Yeah, so you do, yeah, so you can see your negative risk ratio. So um, a lot of people do, they may not do credit spreads, they may just sell naked calls or naked puts, but then, that's got disadvantages. But anyway, credit spreads are, I don't know, I like to marry the credit spread with the other type of strategy. So take the course and you'll see why, and then you can decide if you just want to do credit spreads. But for 197, I think you'll walk away and you'll say, okay, I'm not going to, just do credit spreads on their own. I'm going to combine it with something else. I use credit spreads to hedge. Okay, so that's what you'll learn in the course, using credit spreads to hedge, and then combining credit spreads with other spreads you have on to maximize that trade and make it a better trade. Um, oh, the videos of the trade, they'll be archived in your members area. So if you have a question on any of this stuff, send us an email, support@powercycletrading.com. So if you're a member already or something, you'll receive my video newsletter each day after the close. And if there's a alert trade set up like tonight on Boeing, I have that in the video, the aftermarket video. Okay, so just go look at that. You should have it. You'll usually you receive it email, or you go into your members area and there's a area where you can find that information. Okay. All right. So if I missed anything, let me know. Otherwise, if anybody else would still like to order tonight before we shut her down, just put a number one in. I'll hang around until you have your order. So if anybody else is still interested, just put the number one in. I'll just make sure you have the link and go from there. Yeah, okay, Bart. Yeah, just take your time. And then if you'd like to join us, oh yeah, use this link here. This is course package one. There you go. Yeah, take your time. And then anybody else, just, yeah, put in number one and then just take your time. Thanks, Trader. Oh, okay, great. So here's somebody that just joined this week to actually my trading club here, and I'll pass this on to everybody here. Yeah, and Rachel's my assistant. She helps with everything. Yeah, take your time. You got your link. Make sure you have your link. If you need anything, let me know. And yeah, thank you so much for that nice feedback. Yeah, sure. You can go to package two. I mean, if you there's no discount on price. So excuse me, if you do package two, it's $1,000, and there's a two pay if you want, but you'll get everything here as well. So I don't have any kind of different pricing or discount. Okay, so if you want the alert service, that's what it costs, but you're going to get all this stuff with it anyway. And if you don't use it, you don't use it, but it's yours. So just use it and take advantage of it. And you might want to come back and use it later. So please do join us for the alert service. But if you do it, it's still $1,000, and you're going to get all this good stuff as well. And so use this link here. Yeah, use that link there. There you go. That would be, this will give you all the alert services, all for the trading club for 13 months, plus you'll get everything here, all this. So you'll get the live course, the recordings, and all these bonuses. So it's a really great deal. If you look at it, it's like $70 a month or so, if you look at it that way. Yeah, sure, Michelle, you can do that. Yeah, yeah, definitely. And then I'll just make the adjustment. So yeah, definitely, if you'd like to do that, please do. Just use course package one, then we can upgrade you. Yeah, that sounds good. So, and again, you can start your trading club part of it, trial whenever you'd like. Just send us an email. We're flexible there. Main thing is I want you to come into the Q&As and stuff like that, especially, after you take the course, you can come in for the next 30 days, and if you want, come into the trading room every day, ask questions, or the Q&As every Tuesday, so just want to give you some support there so you can get the benefit, and learn these things if you have questions, which you always will, give you that additional time. All right, so anybody else? Yeah, Bart, you're in. I see you're in, and we'll call it a night here. And I'm looking forward to seeing a bunch of you in the trading room at the Q&As and then at the course. So, um, oh, okay, good. Package two. Let me see. I can confirm. Let me double check that here. Package two sounds good. Oops. Oops. Here we go. So tomorrow, going to be kind of looking at a couple things here. If you come in the room, if you're, I want to see how the markets respond. We did actually in the room today. We did a butterfly short trade. We'll see how it goes. I'll show you real quick, and we'll call it quits for just to fill a gap tomorrow or Friday. So it was a low risk trade using a butterfly. So I can pull that up, show you if you'd like to see it, and we can call it an evening there. Oh yeah, okay. So here, use this. If you took this, like you said you did, here you can join us here. Um, use this link here and join us for a retake of this course. So you'll get access to the live course and the recordings and everything. But since you've already taken it, please do join us here. Use this link here. Okay. I encourage you to do that. There you go. See that? And then you can join us for the course, and then you'll get the live the recordings and the PowerPoint. You won't get all these other bonuses, but you can come back, and do that and access that. Okay. All right. Okay, so we're good to go, I guess. Anybody else? Going, going, going.